All right, let's just jump right in. When you're trying to figure out what a company is actually worth, you hit this wall almost immediately. See, it's not about the numbers from last year, it's about what the numbers are going to be next year and the year after that. It all boils down to one single thing: forecasting future growth. But how do you do that without it just being a complete shot in the dark? And that's the big question, isn't it? The one that makes most of us feel a little bit queasy. How fast is this company really going to grow? It feels like you're trying to predict the future, you know? And if your immediate gut reaction is, who knows? Hey, you're in good company. That is the most common response. But here's the thing. In valuation, who knows just isn't an answer. You have to land on an estimate. So what are our choices? Well, we've basically got three paths we can go down. We can look backwards at the company's historical growth. We can kind of outsource it, asking analysts or even the company's own managers. Or we can do the real work and analyze the fundamentals to find its intrinsic growth. And by the time we're done here, I'm hoping to convince you that this third path is really the only one that makes sense. Okay, so before we get to the right way to do this, let's talk about the dead ends, because the two most common ways people estimate growth are, to be honest, deeply, deeply flawed. On one side, you've got the historical approach, just looking in the rearview mirror. The problem is, the number you get can be wildly different depending on how you look. And on the other side, you've got asking the experts, analysts and managers, but they come with their own huge problems, bias, and a myopic focus on the short term. The thing is, the past can lie to you pretty easily. For example, are you looking at revenue growth or net income growth? Because they can tell completely opposite stories. And what if your starting point, say 5 years back, was just an awful year for the company? Well, your growth rate is going to look artificially amazing. Even the type of math you use, an arithmetic versus a geometric average, is going to spit out different answers. So yeah, history turns out to be a really unstable guide. Okay, so what about asking the folks who should know best? Well, just think about it for a second. Have you ever met a manager who's going to tell you, you know what, I'm a terrible manager and this company's prospects are grim? Of course not. They can't be objective. And analysts? They have a totally different problem. They're often laser focused on one thing: the next quarter's earnings per share, not the long-term value we care about. They're playing a completely different game. So if we can't trust the past and we can't trust the so-called experts, where in the world does that leave us? Well, this brings us to a huge turning point, a really simple but powerful idea that changes everything. And here it is. This is the whole thing right here. Growth has to be earned. We can't just go around deciding that a company deserves a high growth rate. A company can't just wish it into existence. It has to do something to create that growth. So, if growth has to be earned, the next logical question is, how? How does a company earn it? Let's take a look inside the engine room and see where the stuff actually comes from. At its core, it really just boils down to two engines. First, a company can grow by taking some of its profits and reinvesting them back into the business. New projects, R&D, and then earning a good return on that new cash. The second engine is efficiency, just getting better, smarter, and more profitable with the stuff it already owns. Let's dig into that first engine, reinvestment. To measure it, we first have to know how much a company is putting back in, and that's captured by something called the retention ratio. It's super simple. It's just the percentage of the profits the company keeps and plows back into the business, instead of handing it out as dividends. But look, reinvesting a ton of money is pointless if you do it badly. So the second piece of this puzzle is measuring how well the company reinvests. For that, we use a metric called return on equity, or ROE. It basically tells you how much bang for your buck the company is getting on the money it's putting to work. And putting these two together is just brilliantly simple. You just multiply them. If a company keeps 60% of its earnings and it generates a 20% return on that money, boom, its expected growth rate is 12%. It's not magic, it's just math. This is the growth it has actually earned. So what about that second engine, efficiency? It can be incredibly powerful, especially for a company that's struggling. A firm that can improve its return on capital from, say, 5% to 10% can literally double its earnings without reinvesting a single dollar. But there's a catch. This kind of growth doesn't last forever. It's finite. You can only squeeze so much efficiency out of a business. At some point, you hit a ceiling, and all your long-term growth has to come from that first engine, reinvestment. Okay, that's the theory. But what happens when you're looking at a young company that's losing an absolute boatload of money? How do you apply these ideas then? Let's switch gears to a real-world blueprint and see how this actually works. Right, so for a company without any positive earnings, the math we just did, it just doesn't work. So we have to use a three-step process instead. First, you forecast the revenues, the top line. Second, you have to estimate what its profit margin will look like way down the road once it's all grown up. And third, you have to figure out how much reinvestment it's going to take to get from here to there. Let's use Sirius Radio way back in 2006 as an example. It was this young, high-growth story, but it was still pretty small, with just $187 million in revenue. And get this, its operating margin was negative 420%. Nope, that's not a typo. Negative 420%. They weren't just losing money, they were setting giant piles of cash on fire. So how on earth do you forecast growth for a company like that? You do it step by step. You don't assume some miracle happens overnight. Instead, you map out a believable path to profitability over a long time, maybe 10 years. You project that the company's margins will slowly, gradually improve, from horribly negative to shrinking losses to finally hitting a realistic target margin for a mature company. And you usually base that target on what other stable, profitable companies in that same industry are doing. This is how you model that journey from burning cash to actually earning profits. So, after all that, what's the big takeaway here? What's the new tool you should have in your toolkit after this? It really all comes back to this one idea. If you remember one thing from this whole explainer, make it this. You cannot just give a company a high growth rate because it's in a hot sector. Growth has to be fundamentally earned through smart reinvestment and getting more efficient. So from now on, when you see a headline or an analyst report that's forecasting some incredible growth for a company, you now have the one critical question you have to ask. Don't just accept the number, ask, how specifically was that growth earned?